Hey guys, thought I'd make an update video on SPYI and QQQI by Neos, however you want to pronounce them, guys. It's been a long time since I made a video on them, and if you remember in my last video, I talked about how these are two of the best income ETFs out there. This is a dynamic duo. Let's see how they've done in the months since I've last made a video about them and see why so many investors are now dumping JEP-B and JEP-Q and investing in these Neos products, guys. Let's talk all about it. So you can already see here, it's already winning awards. The award winner at ETF.com for the best new active ETF. And QQQI is definitely getting a lot of eyeballs here, guys. Why? Because this is an ETF that gives both growth and income. And this is really attractive in a bull market. It combines equity exposure with options strategies to generate that enhanced yield. So let's talk about that underlying exposure. So they actually own the shares directly of the company. Let's go to their actual holdings. You can see they own companies like Nvidia, Apple, Microsoft. By investing in QQQI, you too are a shareholder of these companies. They don't synthetically own them or fake owning them like some other ETF providers. Here you get the real deal. You get real ownership in major companies. Now, they are also doing options trading. So when they own these companies, they also write call options on about 80% of the portfolio, and these are generally done out of the money. This is because they are actively managed, right? They have dynamic strike selection that helps prevent the dreaded word NAV erosion, and that provides a buffer because they're doing it out of the money. Even if the share price goes up a little bit, they have that buffer to retain some of that capital appreciation. Now, the trade-off is that they're going to get a slightly lower dividend yield, but guys, 14.42% dividend yield, does that sound low to you? This is what basically the brink of how high of a yield you can get without running into NAV erosion problems. I have yet to see anything that can consistently give more than a 12 to 14% dividend yield and not have NAV erosion. Anything that's giving you higher than that is going to run into some serious problems and has not been proven to be sustainable in the long run. Now, because it is actively managed, it's going to require more fees to run it, guys. That's just the bottom line. It's not passively managed. 68 basis points is definitely not cheap. Expense ratios do add up in the long run. But hey, it takes a lot of money to be able to do covered calls, especially on the NASDAQ 100. So to have somebody do it all for you and get some great returns, that doesn't sound like a bad strategy. Now, when they're writing these calls, they get those premiums, and a lot of those are given to us in the form of dividends, but they also use some of the premiums to buy call options. Think of this kind of like a lottery ticket for partial upside participation if the underlying stocks rally strongly. There's going to be those big green days when the stock market just goes to the moon. This is a way to get some of that upside. A lot of times it probably won't ever get used, but it's a way to get some protection there. And this will generally help the NAV grow over time while still giving consistent income for income ETF lovers. And then we also have to talk about the flexibility. Compared to JEP-B, which uses a lot of equity-linked notes or ELNs, SPYI and QQQI are very flexible. They allow the fund manager to adjust the strike prices dynamically rather than being locked into rigid rules. We can see that they actually get some Section 1256 contracts, which are subject to those lower 60-40 tax rates. So what exactly does that mean? It means that gains are treated as 60% long-term and 40% short-term, regardless of how long one actually owns the stock. Remember, that is favorable long-term tax rates. This can actually cap the tax burden even for high-income investors, making it more tax efficient than ordinary dividends from other ETFs. Did I mention dividends, guys? This is where this ETF really shines. Remember, they give you automatic dividend payments. A lot of people that are anti-income ETFs, they'll say something stupid like,
"Oh my gosh, you could just own a company that doesn't pay dividends.
And then you can just sell the shares whenever you want, and you get your own dividend.
Ha 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 ha. You don't need to time the market. You don't need to get the emotions involved. You could just get the dividends sent straight to your bank account. It's that easy. We can see here all the dividends that QQQI has paid this year. And you can see it's been very consistently around that 60-cent mark. Has a little bit of an outlier here in April, but we got back to business in May. And it's been steady and super strong. In fact, it's even increasing as the summer has progressed. If you just owned a company that didn't pay dividends but went up, you would have to make a lot of emotional decisions on when to sell to get those profits and pay for your living expenses. I don't want to do that in retirement. I want something that's just going to give me cash dividends, that's going to make smart investing strategies and be a good steward of my money, good dividend ship to follow, and just pays me those monthly dividend checks. Guys, this is high payout potential. The total returns capture a large portion of the equity upside while providing consistent, attractive dividends. This is what really makes these NEOS products a viable tool for early retirement income, or they could also supplement cash flow. Let's say you had other investments or a pension or a 401k or Social Security. This is another way to just get more income. But that doesn't mean that it's not without any risk. Anything with the NASDAQ 100 is often pretty volatile. It also means that it gets heavy tech exposure. So yes, the triple Qs or the NASDAQ 100 has had strong performance in recent decades, but it could experience significant drawdowns if tech underperforms. So it really depends on how bullish you are on tech for the upcoming future. I personally am very bullish in this particular sector, so I want to have even more exposure to triple QI in addition to the already massive position that the triple Qs are in my portfolio. So I get exposure to the uncapped ETF in the triple Qs by Invesco, and then this is another way to get even more income with options trading on the NASDAQ 100. It's like I'm getting the best of both worlds. Of course, we are relying on a bull market. It's more effective in rising markets. There's not much downside protection in falling markets compared to other fixed income heavy strategies. This isn't a one size fits all, guys. There are some key risks. There are some key takeaways, some limited potential and upside with these income ETFs. They are not magic. They are not a get rich quick scheme. They are not the magic beans that other investors think they are, but these are fantastic ETFs. They give you that growth and income combo, exposure to major tech stocks with built-in income generation. You get active management. These professionals at NEOS, they've been putting out some really hot products, guys. I've seen them more and more often on YouTube. They're giving out some great gems in their interviews. Tax efficiency is built in here as well. I love that they think about that for their investors. Automatic dividend cash flows, hands-off investing approach, and it's just one of many early retirement tools. And we can see since inception for SPYI, which was around August of 2022, it's been over 3 years now, they have not had NAV erosion. In fact, they've been up 7.2%, and they've paid a super juicy dividend, around 12% in dividend yield. If you just own the S&P 500, yes, you probably would have gotten way more in capital appreciation, but you're only getting about a 1% dividend yield, and that's not much fun. We can see here the triple QIs, they haven't been around as long, since January of 2024, but they are up 7.5%, and they are paying close to a 14% dividend yield. You can see a lot of people are now investing in these products. If we go to the triple QIs, they've actually had $3.7 billion in new money going into this fund in the last 6 months. Year to date, it's $4.2 billion. You can see a lot of money just continues to pour into this fund. Very rarely are people actually taking money out of this fund. Now, a lot of people have been telling me that they've sold out of their shares of JEPI and JEPQ and that the NEOS products are better. I don't know about that. I think these products definitely have been getting hurt a little bit more in recent years. I still think they're fantastic products as well. In fact, JEPQ actually has more money going into it than triple QI. Now, of course, JP Morgan Chase is a household name all around the world. That's probably the biggest reason why a lot of people are putting their money into a household name, something that they recognize and trust with their money. But at the same time, the performance doesn't lie. So this is QQQI versus JEPQ in just total price appreciation. We can see over time, this is since September of 2024. The triple Qs, the S&P 500, they of course are going to outpace these covered call ETFs. That's because none of the upside is capped. So the triple Qs return nearly 22%, S&P 500 nearly at 16%. Meanwhile, triple QI is at 5% and JEPQ is at 4.3%. Now, this isn't including dividends. If we just tack on maybe another 12 or 10% to each of them, you could see that they're still in the ballpark of what the overall indexes have returned. If we switch to JEPI versus SPYI, we can see that since September, again, the S&P 500 just outpaced both of these. That's why it's better for younger investors just to simply invest in an index fund and leave these income ETFs mostly for older investors. But hey, there's nothing wrong with necessarily owning both as well. We can see that SPYI is up nearly 2%, while JEPI is down over 4%. Again, not including dividends, but we can just see capital appreciation definitely does matter. It's going to impact how much in dividends that these ETFs can pay out in the future. Long story short, guys, I love NEO's products. Both SPYI and triple QI just continue to be just another amazing addition to our tool belt of amazing income ETFs out there. This can definitely be part of a portfolio designed to live off dividends, sleep well at night, and just get extra income, cash flow coming to us and retaining some of that growth potential. Let me know what you think about these two NEO's products in the comments below. Thank you to my newest Patreon member, Cannon, who now gets full access to my nearly $300,000 dividend portfolio, as well as all my weekly trades, which have been beating the market the last 3 years and counting. Remember, my videos are always found in podcast form under the Collect Cash podcast name, as well as on YouTube under the Citizen of the Year name.
Just learn how to play this fund. Just learn how to play yield max and milk them. Milk them for its worth. I do that.